Hey there, welcome back. In this video, we're going to talk about running for safety. Now, this is a very psychological thing. This is where we feel insecure, we're unsure, and we want to feel stable again. We don't like that feeling of insecurity. So we start looking for distractions, shiny objects, all kinds of stuff. In day trading, that's a real problem because there are a lot of big shiny objects out there, plenty of them. They're all pretty and they all look like they are the magic indicator and that they're going to solve all our problems and we're going to finally make money. So now that is a problem. So in this video, we're going to discuss some of that stuff. So running for safety, the truth is, as we discussed in some of the other modules here, is that you can't control what the market does. You can't control if the market even gives you a perfect setup or not. And you certainly can't control if that setup will work out or not. However, you can control your risk and your potential reward, just as we discussed in the other video. So you really ought to be focused on controlling what you can control, as in control the controllables and don't waste your time and energy and resources on the things you know you cannot control. And there's this other thing that goes into when you have that sense of insecurity where those things you cannot control, you really want them to work out for you. So you start chasing these indicators. It's a psychological running for safety, where you're looking at these indicators and then they give you an indication. And then you start relying on that, thinking, okay, that thing that I could not control, now I know it's going to work. I know exactly what's going to happen. It's going to work. It's hitting that Fibonacci level, or it's holding that moving average, or those Bollinger Bands, or that indication on the level 2, or whatever. And that's really a problem here. We are human beings and we are incredibly intelligent creatures. We're so intelligent that we always end up fooling ourselves. We actually have the ability to fool ourselves and we do it all the time, especially in really highly stimulating environments like day trading. And we'll get into more and more of that now. So, like we discussed, these indicators, a lot of them are people just running for safety, trying to find guarantees and things that there are no guarantees. Okay, but there are definitely indicators that you must be using and you should use them, but you got to really put them in place. So before we really dig into what these indicators are and how they work, what you can use, what you probably should use, you got to really know their place. There are no guarantees. That's the fact of it. That's the whole fact of the market. You cannot guarantee what it's going to do, regardless of 100 different indicators aligning and telling you the same thing. It still may not work out. That's a really important psychological thing. So types of indicators now. There are 3 types. You have past, present, and future. Very simple. Past indicators tell you about action that's already happened. Basically, stuff like moving averages. Now, the majority of indicators are past indicators. It's telling you of what has happened just now or recently or further back in the past. Then you have present indicators, which is basically price action. What is happening now? Every transaction as it is happening in the market. So you have candles and volume that tell you that, as well as reading the tape. The tape is quite precise. It's telling you the transactions happening inside of the candles. And it also tells you the volume. It tells you if the transactions were at the bid, at the ask, in between the bid and ask, or outside the bid and ask. And then you have future indicators that give you an indication of things that may happen. These are things that have not happened yet, but there's a possibility it could happen. And that's the level 2. That's the primary future indicator, the way I like to classify it. It tells you areas of liquidity on whatever security you may be looking at. So when you see indications of level 2, that's interesting. You got to realize that those are things that have not happened. And one thing we all know as human beings, we know about the future, there is no guarantee of the future, right? So even there on these future indicators, there's still no guarantees. I just want to make sure I drill that in. All right, so 3 types of indicators: past, present, and future. And the thing about these indicators is that they're all triggering. They're all triggers. Again, we are human beings. We're emotional creatures. We get triggered quite easily. These indicators, the dangerous part of them is that they can trigger us into destructive behavior. You see a lot of volume come in and it's blowing through a moving average. You suddenly get excited. You want to take a position. You get in heavier than you should. Then next thing you know, it's going against you and you're paralyzed. You can't even stop out. That's what I'm talking about by getting triggered the wrong way. So you got to be careful with indicators. You got to use them the right way and not get triggered into destructive behavior. We'll get into more and more of that now. So 3 kinds of indicators. The first one I really want to get into and make it clear is basically the present tense indicator. Like we discussed in the previous slide, it's candles and volume. So we'll get into that now, here now. So basics right here in the center of the screen, candles. Just to get it going, you have bearish candles and bullish candles. Generally speaking, bearish ones are, most people code them in red, and the bullish ones either green or white. In this slide over here, we'll just go with black and white, right? Nice and simple. You have the, when you have a full body one where it's black, you have the open at the top, the close is at the bottom of the body. The high of the candle is up at the top of that wick, the low is at the top of that, the bottom of that wick, right? And then this one where the body is hollow, the open's at the bottom of the body, closes at the top of the body. The upper wick is the high, absolute high of that candle, and the low is down there, the low of that wick. That's the basics of it. And we're going to talk about patterns and how we use this stuff. So there are various different candles that can form. You have them right here. You have a doji. A doji is basically where the candle opened and closed in the same place. It had a high there and a low there. And so it moved into this range, moved up and down within this range, and it opened and closed pretty much exactly in the same place. Then you have spinning tops, which have some sort of a body. It's basically a version of the doji. It has a small body and long wicks. Same thing over here. You have the open down here on the white candle, the top up here. So you know that it opened here and it closed above where it opened. But it does have wicks on both sides. So it actually moved this entire range during this time period. Same for this candle. In this case, the open is up here at the top of the body and the close is at the bottom of the body. And during the time period of the candle, it moved the entire range. All right. Pretty simple. And you have these candles. We'll get into more and more details about these. So basically, this is a big one. This is a small one, big one, small one, right? And you have different variations and combinations of how you can have them. You had a bullish candle, as in the price went up and then went up more, a little bit, not a whole lot. Here in this one, the price went up, it gapped up and the price went down a little bit. Over here, the price went down and it actually gapped up and it went up a little bit. Weird, huh? But you see this stuff on daily charts. And this one, the price went down and gapped up and it came down a little bit. Interesting, right? Weird kind of price action. You can see this stuff. Here you have one where the price went up and then went down, basically, and engulfing. So just these are the basics of candles. The main thing you want to understand right now is where it opens, where it closes, the highs and lows, basic stuff. Let's get into the meat of it, though. Let's start on this side. Candle patterns, you want to be able to use them. Now, candles are very interesting. They are real time, as in I like to classify them as present indicators. It's happening in real time. You're able to watch them form. You're able to watch every transaction that comes through, right? So take a look at this. Let's say the market is in a downtrend. Okay, it's coming down. And then you get this candle here. This is a hammer. It's called a hammer. It looks like a hammer. That's basically it. It opens here, pushes down, and as it's nice and it's a red candle, a great big red candle. It somehow finds buyers down there, right? And the buyers are so powerful, they push it right back up past the open of that candle and end up closing it above. Now, this is a very bullish signal, especially at the bottom of a downtrend. The first thing that you get at the bottom of a downtrend when you see a hammer is the first thing you got to understand is that that downtrend is over. It's over for now. It doesn't mean that it's going to reverse. It's telling you that the downtrend is over and wait and see what happens next. So these hammers, they're very powerful at the end of a trend more than anything else. Let's look at this one. It's coming down. And then it has an inverted hammer or a reverse hammer. In this case, candle opened down here and it pushed up, right? So quite a bullish bit of action there. But then there were sellers here that pushed it right back down, but it still closed a little above where it opened. So you can see this one also is telling you now the buyers have come into the picture after a downtrend, right? So that trend is also over. Now, this is not as bullish of a signal as this one here. Because in this one here, you can see the buyers in the end, towards the end of the candle, really the sellers towards the end of the candle really started pushing it down, right? It's the opposite of this one. While this one also does confirm that, okay, that trend is over for now. It's not as bullish as just having a hammer. The inverted hammer is not as bullish as a hammer in this context at the bottom of a trend, okay? It's different. It's the opposite over here at the top of a trend. We'll get into that in a minute. And down here, up here coming down in a downtrend, same thing as a hammer. We call it a dragonfly. The only real difference is that the body is non-existent. The candle opened and closed in the same place. So very similar to the hammer. And over here we have a spinning top. Well, you have it there. At the bottom of a trend, right, like coming down, if you see this, it gives you the same indication as any of these do, which is basically the trend is over for now. If you're in a bearish position, this is maybe where you want to start taking some profits. It may not be at your target yet, but you don't know if it's going to continue to go after you see these signals here at the bottom of a trend. See this kind of thing? You see these hammers, reverse hammers, you want to start taking some profits here because you just don't know. It could reverse. It may well reverse. But again, the market does not do guarantees, right? So you just got to work with what it's talking to you, what it's telling you, right? So let's get into a few more complex patterns, 2 candle patterns. This is a funny one. We'll just go through it real quick. Basically, very bearish, gapped up, and it goes up. That's very bullish. Now, you don't see this often on a 1-minute chart. So for day trading, it's not truly relevant. But you see this on other time frames. You might see this in low float stuff with a great big gap. On 1-minute charts, you rarely see gaps. So, we'll just skip over it real quick. This one, however, is important. This is a bullish engulfing. So you have a bearish candle here where basically the sellers are in charge because it opened here and it closed here, right? So overall, the sellers are in charge. But then the very next candle is the opposite. It's a bullish candle and it completely engulfed that previous bearish candle. It's called a bullish engulfing. Now, bullish engulfing is a very bullish signal, especially if you have them at the bottom of a trend, right? So what it's telling you is that this was bearish, the bears were in control, and suddenly the bulls took over. Quite amazing, especially again at the bottom of a trend. After it's been going down, this is another signal that that trend is over for now. Here's another one, bullish harami or harami. I'm not sure how it's pronounced. It's Japanese, but when you're coming down in a trend, you have a bearish candle, and then the next one is the opposite of the engulfing candle. You have the bullish candle inside of the previous bearish candle. Another signal that trend where it was constantly making bearish candles, that trend is over because this is something else completely. It's got a whole different behavior. It's not able to continue and make a new low. So that trend for now looks like it's over, right? And the bulls are starting to get involved. I don't see this as bullish as the engulfing. The engulfing is really, really bullish. But this one is also a signal, just like these are. This 2 candle pattern is a signal that that trend is over for now. Here's another one, a piercing line. Again, the thing is coming down, the whole price action is coming down, and then you have one candle that is bullish where it opens slightly below the bearish candle and it closes inside of the bearish candle, of that previous bearish candle. It's called a piercing line or a piercing pattern. So it's really piercing into those bears. It's the way to see it. Again, same idea. It's giving you an indication that this downtrend is over for now. And here's a tweezer bottom. Tweezer bottom is truly nothing more than, you can see the wick down here on this bearish candle. And the next candle also has a wick down here at the same place. This is telling you that there are buyers sitting here, 2 wicks in a row at precisely the same place at the bottom of a trend. And that's how it signals the bottom. By the way, when I keep saying bottom of a trend, you don't know it's the bottom of a trend until you start seeing all these signals, right? So when you start seeing these 2 wicks at the same place, after it's been moving down, now you can get the feel that this is the bottom of the trend for now, temporarily. It could be a consolidation and continue down, or it could reverse, or it could just sit there all day. You don't know. But all you know is that what's been happening, as in it's coming down, that has stopped happening when you get these kinds of patterns. The tweezer bottoms I find very powerful. I see them almost every day. I use them almost every day. They're very, very powerful in 1-minute charts on day trading. Then you get more complex with it with 3 candle patterns. You have this one, basically called a morning star. Nothing more than you'd have a downtrend. You have a little tiny doji candle, small body at the bottom, and then it pops up. And that gives you a bullish. It's like a V reversal almost. This is the same kind of situation. Now, these ones have gaps in them, right? Again, you don't see gaps too often on a 1-minute chart. You'll see it on a daily chart more often. You'll see gapping price action. This is where this stuff becomes more relevant. How do you read these gaps? So the morning star basically is saying it's coming down, and at the bottom, it did a tiny little candle. That's like a star. Morning star means it wants to go up. It's like the sun going up. Same idea. Here, the bullish abandoned baby, similar to that Morningstar, but there's gaps on both sides. This is actually a very bullish signal. You see this on daily charts at the bottom of a move. Well, after a move down, you see this, and you have a good feel that that's the bottom of the move. Here, this is a trend continuation signal right here. You get 3 candles in a row. We call them 3 white soldiers, 3 black crows as they go down. Same idea, just in reverse. And that's telling you that that's in a trend. 3 in a row is pretty good. Is it going to continue? No guarantees, but it's telling you that the trend is intact. So one of those things to look for. This one here is very interesting. You can see this on any time frame, even 1-minute charts. It's bearish, generally speaking, but then you have one great big bullish candle that engulfs all of those previous bearish candles. Now that is a very bullish signal. Again, I've seen this plenty of times. Right? You have 3 red candles and then 1 bullish candle that outweighs all of them, that engulfs all of them. This is also telling you that a bullish setup is about to take hold. The buyers are starting to take over. Right? No guarantees that it's going up. But here's where you can get the feel that, okay, something's brewing here. The buyers are getting excited here. They're ready to get involved. They're ready to play their hand. Right? Here, over here, Morningstar, similar to the Morningstar here, just a doji, same idea. It's coming down, an indecision candle. By indecision, I mean it basically opens and closes in the same place. Like there's a doji there, doji's indecision. Wicks on both sides. And then what you want when you see an indecision candle is you want it to make a decision. That's basically it. Indecision, ideally you want it to make a decision that you know which way it's going to go. So when you have a bearish move, as in it's on a downtrend, and then you see an indecision candle, you can immediately begin to think, okay, that trend going down may be over now. And then after an indecision candle, if it makes a decision, means it makes a new high. That means, okay, it's perhaps the buyers are getting excited. Perhaps it's going to begin a new trend. Or if it makes a new low, perhaps that trend is now going to continue. But when you see this doji here at the bottom of a trend, or at the top of a trend for that matter, same idea. What you can already get the feel for is that the trend is over for now, right? These ones are more obscure. You don't really see them often, but basically you get a small bearish candle and then an engulfing and then a continuation to the upside. Well, no, this is pretty obvious. Looks like it's really getting to go. As in, you have the engulfing, which is bullish, and then it makes a new high. All right, there you go. You don't really need to think too much about this one. Fairly straightforward stuff. That's just confirmation that it wants to continue. And here's another one, a little different. Very bearish. You have the Harami pattern, right? That we saw. Where was it? Here, there we go. This one right here, where it's coming down, is in a downtrend, and you have a bullish candle inside of a bearish candle, and the next one breaks out. Same idea. It's starting to, over here is where it's telling you the bulls are getting excited, and over here it's giving you confirmation because it's moving up. It's making a new high, and it's getting ready to go. So over here, getting confirmation that the bulls are pushing through. So you can get more excited about a move to the upside in this case. Now, going to this side of the screen, it's everything that we saw here in reverse. So it's in an uptrend. You see a hanging man. It's called a hanging man because it's right at the top of the trend. It's a signal that that uptrend is over. Over here, the uptrend, a shooting star. That's what it's called at the top of a trend. At the bottom of the trend, it's called a hammer. Top is called a shooting star. Same idea. It's telling you that that uptrend is over. It may well begin a downtrend. The gravestone doji, similar idea. Again, telling you the uptrend is over. And then, of course, you have the spinning top. Same idea, just telling you about indecision. Now, these are all really powerful things to look at. Okay, over here you can see it's been in an uptrend and it found sellers up here and it's pushing down real hard. Again, found sellers up here, pushing down real hard. These are very bullish. This one, these are very bearish. This one is also bearish, but not as firm as these ones. I give more weight to these, especially accompanied by volume, which we'll get into now in a minute. So anyways, the point is over here, it's just everything in reverse that we discussed on the bullish side. Same thing here, nothing really too different as we discussed here on the bullish side. Here's the bear side. Same idea. The tweezers, you see them all the time. I see them almost every day, quite literally. You get into an uptrend and then you see a small wick here and then followed by another wick there. You can tell that there are sellers sitting there. There's a level right there. If you're watching the tape, you'll probably see that it's always selling. When it hits that level right there, there's lots of sellers just hitting the market, not nonstop, constantly. So you may be even able to use that as risk management, as in if you're taking a short position, you can put your stop loss right on the other side of those tweezers, just up there. Nice tight stop loss, giving yourself asymmetric risk to reward to your target, right? So really good stuff there. Here, dark cloud cover is just the opposite of the piercing line. Same old thing. It's in an uptrend, and then you have a candle, a bearish candle, that closes inside of the bullish candle. It pierces that bullish candle. It's called dark cloud cover, just like the weather over your head. So same idea as we discussed there. The bearish harami candle, basically it's bullish, it's in an uptrend, and then suddenly you see a bearish candle inside of a previous bullish candle. Is telling you the trend may well be over. The engulfing, that's a very, very powerful one. I definitely look at this in a very serious way, look at it every day. It's in an uptrend, and then you have a bearish engulfing candle. It basically engulfs the previous bullish candle. It may well be getting ready for a downtrend in this case. But for one thing's for sure, that uptrend is over for now, right? And again, here's something you don't really see often. You might see it on daily charts. You got bullish, and then it gaps down from, it's a serious gap because it closed there, and it gaps down even below the candle that, the open of that previous candle, and then it pushes down even further. Very, very bearish. Again, this is more on bigger time frames. You don't see this stuff on 1 minute charts too often. Those are the 2 candle patterns on the bearish side. Now, 3 candle patterns, again, everything in reverse. Is really not a whole lot to get into. We have the abandoned baby. It's going up, makes a great big shooting star. Well, I like a shooting star, but little candle up there, doji, and then the next one gaps down. You have a gap in between all these candles. It's called the abandoned baby pattern. Nice little, colorful name. You have the 3 black crows, basically 3 in a row, confirming that the trend is intact going down. This evening star doji is very similar to the abandoned baby doji. It's basically without a gap. Same idea. It's telling you that that move up is over. And the evening star, you have a gap and then an indecision, basically a small candle, and then a new low, telling you that's an evening star. It might be getting ready for a downtrend. So there you have it. This really is the 80-20 of candlesticks. This is it. Yeah, I don't think you need a whole lot more as far as candlesticks go. If you can understand this, then you can put in together various combinations of these, and you have patterns. You have ABCD patterns, you have double bottoms, you have head and shoulders, all that stuff. It comes from these basics. Really, these basics are really, really crucial to understand. Understand where the open, close, high, and low are. Identify where you can start to see buyers and sellers, like these tweezers, right? Right over here. You can start to see sellers up there if you have 2 in a row at the same level. Okay, you see them at over here too. You find buyers down here, 2 in a row at the same level. Buyers keep coming in right over there, right? So there you go. You can use this kind of thing. You can find over here, buyers are sitting right there. Buyers are sitting right there. Sellers right there and right there. For example, here, this thing is coming into a downtrend, right? And let's say it does this hammer and it starts moving up, and then it pops down again, and it finds a bottom again, exactly where it found a bottom previously. Well, you put this together, now you got a double bottom. At the bottom, in a downtrend, when you get a double bottom, basically a W pattern, that's a very bullish signal. It may be well ready to go for a reversal. So you can get these ideas here. It's very powerful stuff. So again, being able to read candles and these basic combinations of candles are really the most powerful indicators here, as in they're in the present. Remember, there's 3 tenses of indicators: there's past, present, and future. Candles are very much in the present, especially in day trading. You're watching the 1 minute chart. You're watching how these candles are forming. You're watching it go down and getting pushed back up, go down, getting pushed back up. Within a 1 minute candle, you might see getting pushed back up 3 times, for example, right here in this candle. Within the formation of the candle, like 3 or 4 times. Well, you can tell then, look at that. There's buyers sitting right there. This is without even reading the tape. You can read this stuff. Just observe how these candles are being formed. Once they're formed, then they're on your chart and you can read it. Okay, it's a doji, it's a spinning top, whatever it is. But watching how they are being formed is important. And that's when you want more detail on that, you got to get into reading the tape. That stuff is fascinating. Really, that's a whole nother world. And it gives you a lot more insight on what's going on inside of the candle. But just watching it form visually will already give you 80% of the insight you need on what to do with these candles. Where are the buyers? Where are the sellers? And that's really very important. These candles, again, to repeat, is a powerful indicator. These are more powerful than past indicators, like moving averages or past indicators, telling you what happened in the last 9 candles or 20 candles or whatever. And that's past. And really, truth is, I don't rely on the past very much. The present and the future are far more significant, specifically the present, because that's all about risk management. Where can you enter a trade and put your stop? So if you're confirmed about this double bottom here, for example, you can enter the trade. Your stop loss is right below the double bottom, right down there. And you're entering right above. You know that if it comes down below that double bottom, then that double bottom is no longer valid. The pattern has failed. Okay, so you stop out. Fair enough, right? So watching these candles, watching how they form, really in real time, in the present tense, is extremely powerful for risk management. I can't even tell you how amazing this stuff is. And it's not a whole lot of work, but a lot of people just kind of glaze over this and don't pay too much attention to the candle patterns and more specifically how the candles are being formed. So when you get this going, when you spend a lot of screen time and you do this and you practice this, you'll be able to really pick out those buyers and sellers and pick out those tight entries, which then translates to really good risk to reward on your trades. So here's another one on present tense indicators, volume, right? I figured I'd put a great big dramatic image out here. Volume is the strength behind the punch when a boxer is in a fight. Think of this. So when a boxer throws a punch at the other guy, that punch better have some real power behind it, have some strength in it, because you don't want to hurt the guy. You want to knock him out, right? If you hurt the guy, well, he'll hit you right back, right? You really want him to, you want to knock him out so he doesn't hit you back. Quite simple. So you got to think of volume that way. It is the strength behind the punch. If the boxer does not put strength behind the punch, most likely that boxer will probably break his wrist just trying to throw a punch and then get knocked out himself in a minute. So it's the same thing in volume. It's the strength of the candle. How significant is that candle? How much weight can you give that candle? That's volume. Think of boxers throwing punches. How much strength is behind the punch? Is it weak or is it strong? That's how I see volume. So I'm going to share that with you here. So right here in this one, check this out. It's in an uptrend. Nice and simple, right? See the volume, okay? It's going up. These candles are getting bigger as they go up. The volume is getting proportionally bigger as it goes up. This candle is significantly bigger than this candle. This volume is significantly bigger than this volume. Everything is in perfect proportion. It's in harmony. Everything is working, right? No big deal. Then it's coming down. You have a couple of red candles, right? Remember, you got tweezer tops here. Interesting, right? So you get beginning, when you see tweezer tops, you're beginning to think that, hey, now this could be the top. Maybe this is a short, but hold on and wait and see. Look at this candle right here, this red one. The volume is low. The next red one, the volume is low. Okay, it's decreased volume. So what this is telling you is that the move down is a lot weaker than the move up. Okay, the move up was healthy. Everything was in harmony. Everything was proportional. Okay, and it's working. But there's nothing here telling you that it's significantly reversing. Let's draw the comparison so you can get the clear picture on this. Now look at this one. Things are moving up, just like in this one, but look at the volume. It's decreasing. And here, this green one, this is a bit of a weird one because look, this candle is significantly bigger than the previous candle, but the volume is lower. It's not in harmony. It's in divergence. This is an anomaly. This is weird. This is, you got to be careful with this. And then you get a tweezer top. And with the red candle, this has a small body compared to the previous candles, but large volume. Now you got a real serious anomaly here. You got a tweezer top. You got a weak uptrend right there with the volume decreasing. You've got a tiny little red candle with massive volume. Now here's where you can get really confident about the reversal and the downtrend. In this case, you can think, okay, perhaps the uptrend is over for now. In this case, you're thinking the uptrend is over and perhaps it's getting ready for a reversal. It may retrace the half the move or maybe the whole thing, and you can take that trade, right? And you can see that as the second red candle forms, it's increasing in volume. Now, this is in harmony, right? This candle, this red one, is bigger than that first red one. And therefore, also the volume is bigger than that first one. Therefore, you have harmony. This is likely to be a healthy down move, downtrend. So you can see the big difference. The candles are the same. You're seeing the patterns in the candles. We discussed candle patterns, right, a minute ago? but now we're putting in volume, and you can see how it changes everything. In this case, I would think this is an uptrend. It's just doing a pullback, and it's likely going to continue. It's an ABCD pattern. This is the beginning of an ABCD pattern, more likely than not. And this one, I'm thinking, okay, this is a serious reversal. We got a top here. The down move is healthy. It's likely to make a double top, maybe just test that high again. You can trade the double top going down. Right? Or it could be the first indication of a big head and shoulders pattern for a serious reversal trade. You very rarely get V bottoms or V tops where it goes and just reverses quickly, especially on a 1 minute chart, day trading 1 minute charts. Wait for multiple candles to come together. It's only 1 minute at a time. Okay, so don't look for V reversals. Those do happen, but they're very rare and they're very risky if you trade like that. Wait for double tops, double bottoms, those sorts of things, or big head and shoulders patterns, or reverse head and shoulders. And in this case, you're getting a very good indication that this could make a good double top, and then you can take that trade. And it's the volume that tells you that. You can see that these are two completely different pieces of price action. Even though just looking at candles, they look identical. They are identical just on candles. But one's in harmony, one's in divergence. And that's the big difference. And really, this is the 80-20 of volume, of how you use volume. It is the strength behind the punch. Look at the strength on this one. This little candle packed a real punch, right? Amazing. Look at this one. This was a big candle and it packed a real punch. It's still ready to go. This one, tiny candle, tiny volume, nothing serious. You can't take it too seriously, right? That's what I mean by strength behind the punch. Think about boxers and how they do their sport. So again, this is the 80-20 of reading volume. This is the majority of what you need to know about reading volume. There's many, many more details you can get involved in, but this is it. This is the big picture, the majority. You just read this stuff, this combination of candles and volume in the present tense. These are present indicators happening in real time right here and now. You sit here and you read candles as they form with the volume and coordination. Are they in harmony or are they in divergence? Is there a volume anomaly? You just sit and identify this stuff and you can get some seriously powerful trades off of this. Most of my trading is based on this. This is the primary indicator I use, by the way. Primary, candles and volume. And to assist candles and volume, I read the tape to try and get an understanding of what's going on inside of the candle, right? This is the present tense. These are the only indicators that actually are in the present tense that you can actually seriously use for taking on some serious trades in day trading. So let's bring it together a little bit. We talked about candles. We talked about volume. Let's talk about some strategy. Let's put it together. All right. Wyckoff, I'm sure a lot of you may have heard of Wyckoff. He did a lot of work analyzing the markets, figuring out price action and all that. So this is one of the diagrams he put out for all of our viewing pleasure. In my opinion, 90% of what's on this diagram is useless. But there is some fantastic insight in this. Fantastic and really powerful stuff. I'll just break it down for you, make it nice and simple, so we can really just use it. Very simple. When price is stuck in a range, well, you can figure out the resistance and the support. How do you know it? Well, it hits the same level a couple of times. So you can draw a line up there. It's the same level a few times. There's no specific number, 2 or 3 or 4. But when you start seeing it consistently to your eyes, if it's consistent, you can draw a line. Okay, now it's important. It looks good to your eyes. And so therefore, for some people, they need to see it hit 5 times before they can draw a line. Some people 2 is enough. Again, you're going to be drawing the lines on your chart. You better be believing in those lines. It's irrelevant if somebody else does, because you're the one who's going to draw it on your chart. You're the one who's going to risk your money on those lines, right? So you better draw it when you are convinced of it, not when I'm telling you to or somebody else is telling you to. It's up to you to watch this price action and figure out where is support and where's resistance. And if you see it constantly going back and forth, you have what is a range. Nice and simple. When you have a range and then you get a breakout, breakout is when it breaks out of the range. So in this case, right over here, it starts to break out of that range. A lot of times you'll get a false breakout. False breakout is it goes back into the range. That's it. It's a false breakout. How do you know it's going to be a false breakout before the false breakout is complete? Well, volume. Volume is the key indicator here. So you have the candles and your levels. And as the candle starts breaking out of the level without significantly increased volume, so it's a low volume breakout, it's unlikely to be a genuine breakout. for a real genuine breakout, you want increased volume, you want elevated volume, you want excitability, ignition. You want the thing to go, explode, break out of this whole area that it's stuck in. You need some serious strength in that. Again, think of the boxers with the strength behind the punch. You want to knock out that level and go, right? So when you're getting a breakout with low volume, you can anticipate a false breakout. It happens very common, very often. I see it almost every day, really. False breakout. Now, when it re-enters the range right over here, what you typically get is it retests the bottom of the range right there. So false breakout with low volume, re-enters the range, and a retest of the bottom of the range. And then what's really typical is that after it does a retest, it bounces off the bottom here, it sets up for a genuine breakout on the other side. This is very typical. So you can almost anticipate a genuine breakout after you see a false breakout. And again, I can tell you, I see this stuff almost every day on the time frames I watch, which is 30-minute and 1 minute, and you'll be able to identify this on basically any time frame. When you see a false breakout, you can anticipate a genuine breakout. Now, how do you identify a genuine breakout in real time when it's actually happening? Elevated volume. Seriously elevated. By elevated, I don't mean it has to be massive. I mean just elevated from the previous action. Just look at the volume in the last 10 candles, 5 candles, whatever it may be. And you just want it to be seriously elevated. Okay, double is a good one. Double of the volume of the previous candles. You don't even need to use volume average indicators or various things. You just look and eyeball these volume bars. That's all you got to do. Keep it simple. Too many indicators confuse the mind, and that's nothing more than running for safety. Again, remember that? We were talking about that. So really, genuine breakouts happen with genuine volume, increased volume, ignition. Think about starting an engine, that ignition, you need that. Think about the boxer with the punch. You really want to punch through that level. So when you get the breakout happening and the volume is elevating, the speed on the tape is accelerating, all that stuff, everything's just lighting up, right? It's likely to be a genuine breakout, as in it's not likely to come back and settle back down into the range. It's likely to make a move. Okay, so then what happens right after a genuine breakout? Most of the time, I'm saying 70% of the time, you get a retest. So it breaks out, it's a genuine breakout, but it's not a false breakout. False breakout is it comes and settles back down. You get a retest of the breakout area. Notice the word area. Okay, it retests the area of the breakout, not precisely where you drew your resistance line. It can retest precisely the resistance line. It can retest a little above it. It can go in up to even halfway into the range and then bounce back out. It retests the area. And that's a key point. A lot of people get messed up with these lines and think of them as precision. They're not. They're areas. All these lines are areas. So here's the breakout area. Here's a retest of the breakout area, and then it's on its way, one leg up. So after the breakout, after the retest, you get one leg. Then very typically, you get a consolidation. Remember that it's a healthy move, and the consolidation as it comes down was on low volume. Those red candles, low volume, like that previous slide. And that's how you know it's a consolidation. And then it gets ready for a second leg up, and that's the end of the move. 2 legs. You can count on 2 legs. Sometimes it does do a third leg. A lot of times it does, but it's unreliable. What you'll find is you can count on 2 legs, and they're reliable. You can take these trades quite often. They work often. The third leg is risky. Now you're going into the territory of gambling. All right. So plan on 2 legs. So that's it. This is the structure. Range, false breakout with low volume, retest of the false breakout, a genuine breakout with high volume, retest of the breakout area with low volume, 1 leg up, consolidation on low volume, second leg up, and that's the end of the move. And the same thing happens in reverse. So this is it. This is how price structure works. This is, if you just understand what this is, how this works, you're able to identify this real time while you're watching the market. There are so many opportunities to take trades and really great big trades. So let's get into some of these now. Take a look. You have a range. When this thing is breaking out on low volume, you can anticipate a false breakout. Comes in, it confirms a false breakout. Then it retests here, starts to bounce. You can enter here on the bounce. Get in here, stop loss right below. And because it was a false breakout, you can anticipate a genuine breakout. So as you enter here, you're getting to the top of your range, and you're seeing the volume build up and it's breaking out. Well, you can add in over there. Move your new stop loss to halfway, about the middle of the range. right? Ideally, now it's a break-even stop loss. And then you get a retest of the area. As you're seeing the retest happen, starting to bounce, you can add in over there. Move your new stop loss to just below the retest area, right? Again, break-even stop loss at this point. Take that one leg up. You notice the consolidation. You can add in during the consolidation. Now, your new stop loss is right below the consolidation level. Take that second leg. Now you take profits. I mean, look how powerful this trade is. This is enormous. You're just adding in every time you get more confirmation, and you're moving your stop loss up as well. Now, this stuff is powerful. This is where you risk $1, and by the time you're sorry, where is it? You risk $1. By the time you're done with it, it's like $20 in rewards. It's 20 to 1. When this works out, when you do it right, you execute it right, all this stuff. I mean, that's the ideal situation. I can tell you, I've taken trades like this, where I'm entering at the false breakout retest, then adding at the breakout, adding at the retest, adding in the consolidation, taking the 2 legs. That's where you make the big money, and taking it off at the top. So this stuff works. It does happen. You see it all the time. And so as you can see, there's various opportunities to take trades. Now, you don't have to trade it exactly the way I just said it, as in keep adding in and going for the move. There are various different ways to take it. You can take it this way. False breakout, you enter at the retest of the breakout, and your trade is in the range. You take it up to the range. Okay. Take your trade off here. Another way to do it is wait for the breakout and enter a trade at the breakout. How do you know the breakout's going to happen? Well, after you've had a false breakout, you have a good breakout opportunity, right? You can anticipate it happening, especially when you see the volume happening as you're breaking out. Or you can wait and enter at the retest. Over here, the retest is probably one of my favorite entries because you get such enormous confirmation, right? Because what you've had at the retest is you've had a range, a false breakout, a genuine breakout, now a retest of all that stuff that's just happened. And you can stick your stop loss right below the retest area. So pretty tight stop and 2 legs up. Really good risk to reward. That's why I like this one. You can get really good risk to reward with really good confirmation on the price action, on the price structure. And you go. And let's say you miss the whole thing. For example, you miss out taking the retest here, taking the breakout, taking the retest here. Well, you still have an opportunity here to enter during the consolidation. Observe 1 leg up, watch the consolidation, and get ready for the second leg and take that. You can enter during the second leg, tight stop. You can still make 5 to 1 without too much fuss. I take these trades a lot as well. So you can see there's multiple ways to do this. Multiple ways. Another way is this trade the range as you observe the range. A lot of people are range traders. They like to trade the range. Okay, do that. If you're able to identify it and if the range is truly big enough that there's room to make profits. If you are trading the range, the one thing I like to say is you want to trade, you want to enter only at the edges of the range, okay? And you want to take partial profits in the middle of the range. Because you don't know. Sometimes it'll go in the middle, it'll mess around, and then it'll come back and maybe have a breakout the other way or a false breakout, on the 1-minute chart. So if you're really trading within a range and you identified, okay, you're inside a range, you're trading inside of it, only enter at the edges and consider taking partials in the middle. Be prepared to take partials in the middle. Your target is, of course, the other end of the range. And that's it. So just on understanding price structure, understanding candles and volume and how all this kind of syncs up together, you can really take some powerful trades. The truth is, this is my trade book. This is how I trade. The majority of my trades is this. It's not too complicated. It's really not. You just got to get a grip on how things sync up together. You have price structure, you have candles, you have volume. And then, therefore, you have opportunity, right? Do it all with massive asymmetric risk to reward. Now you got something. You really got something. All right, let's move on into the next thing. So everything we discussed there was basically the present tense, right? Candles, volume. Fortune telling, the future tense, future indicators. That's the order book, level 2, right here. So here's a depiction of the level 2 on DOS. And what we're watching here is, look at the price. Right now, the price is 137.47. Okay, right about there. That's over here. You can see the bids are sitting at 137.43. The ask are sitting 137.46. So the price is basically right in between that, 137.45, let's say. That's where it's transacting. It's got a 3-cent spread. All right. Now, you got to look further down the order book. And this is where it becomes powerful. These are asks. Asks are basically asking price. People want to sell their shares and they're asking a certain price. As you go down the order book, you notice that there's a lot of 4 to be sold at 137.49. Somebody's asking for that price. You go further down, you see another lot of 3, another 4. Here's a big one. This is a standout one. 11, 137.65. Another big one. 137.70. It's even bigger. These big ones that stand out, these are the ones you got to pay attention to. This is the fortune telling side of it, right? The future tense. It's telling you that if this thing AMD is in an uptrend, and if you're in that trade or you're trying to get into that trade, you can look down the order book, look further away from the price, and see where those big sellers are sitting. These guys have a lot of shares they want to offload at these specific prices, and they're not going to sell it lower. They're waiting for the price to come to them. These are the big money guys, the smart money, right? Big positions, and they're waiting for the price to come to them. So you can use these as targets. So if you're in an uptrend and you're in a position, there's a target. You have 137.65, you have 137.70, right? You have these targets as it goes. You can target to take profits at these levels where you see big sellers sitting. That's really it. That's the majority of how you can use the order book. That's the 80-20 of using the order book. You're looking for targets. It's the future tense. It's stuff that hasn't happened yet. It's an indication of what may happen. It may get there and resist there because, well, there's lots of sellers sitting there. That's all it's telling me. And it's the opposite on this side of the screen, on the bid side. Look down the order book here. You get some size here, about 5 at 137.34. But look at the big standout one, 137.21, right there, 15. There's a big buyer sitting there. If you're in a short position, right, you can target this level right here, 137.21. Why? Because there's big buyers sitting there. Those buyers will come into the market, as in they'll start buying right there. Maybe it won't go lower from there. You don't know. So if you're thinking about getting into a position, you can use this as a target. So make sure you have asymmetric risk to reward if you're getting into it and this is a target. On the other hand, if you're in the position, this can be a target. Think about taking profits over there because there's a big seller sitting, a big buyer sitting right there, and he may not let the price drop further. It might be a very big buyer, and that's it. That could be the low of the day. So that's it. That's the order book. That's the future tense. That's really the 80-20 of using the order book. You just kind of scroll down the order book, looking for these standout big numbers. Typically, the biggest numbers happen at round numbers, like 135, 140, 145, 150, massive, right? Usually at nice round numbers, you'll find these big buyers and big sellers waiting there. And again, you got to use them because these are the big guys. This is the big money, the smart money, and they're patient. That's what makes them smart, right? They're waiting for the price to come to them. So why don't you ride the price to them? Take a trade, right? That's your profit opportunity. That's how you use the order book. Looking for targets, looking for where the big buyers and sellers are sitting. That's it. That's some fortune telling for you. Here's another little bit of fortune telling, which I think is even simpler. Really amazing. This is stuff I use quite a lot, especially when trading the S&P 500. So measured moves is what they're called. Check this out. A, B, C, D pattern, right? A, B, C, and then D. Okay, it's fairly straightforward. We've all seen this before. Look at the distance from A to B. Let's say this is a $10 move, okay, for example. Then it consolidates, low volume candles coming down to C. So you're convinced it's a consolidation. It's not a reversal because it's coming down on low volume. So now what you're doing is trying to find the bottom of the consolidation. Okay, when you do find it and you're convinced of it, you're measuring the move to the next target, the second leg. Remember we talked about that Wyckoff 2 legs up, first leg, consolidation, second leg. So you're getting ready for the second leg, but how big is the second leg? Where's the target? One thing is the level 2, like we discussed. The other thing that actually a lot of times aligns nicely with the level 2 is a measured move. So you measure this distance. A to B was $10. Once you identify where C is, you just add $10 to that. D, the target is $10 from C. So let's say this thing started at 20. B happens to be $30. Okay, so C then, let's say it's $5 below. So that's at 25. This was a $10 move. C is at 25. So you add $10. Your target is 35. That's it. You plan your targets like that. On an ABCD pattern, nice and easy. You can actually measure the move of A to B and then start the second move from C and just put on the distance from A to B There you go. You have your target. That becomes D. Ideally, when you do this, take a look at the level 2. Around that area, you want to see big sellers sitting there. Now you see you're getting it all coming together. You're getting conviction on the target by putting the level 2 along with the measured move in the same place. If they align, and ideally they also align with a horizontal line on your chart, there you go. Now you got something serious to work with, right? Very interesting stuff. Fortune telling. Where's the future? Take a look at this format over here. Just like we discussed, a range. Let's say you get a genuine breakout of the range. You want to target this move. How do you know where the profit target is? Same thing. Look at the range. What is the distance in there? Right? Let's say it's $10 here. Therefore, the target is $10 up from the top of the range. That's it. Fortune telling, telling you where the target is. Well, how far can it possibly go? Now, these are measured moves, right? So they're imprecise. They're approximations. So when you're doing this, what I really enjoy doing is looking at the level 2. I use the measured move, find a target, then look at the level 2. Ideally, there's something sitting there, a big seller sitting there. Ideally, it's a round number, somewhere in that area, somewhere a little below, a little above, but right there, you can use that as a target. And ideally, it also aligns with a nice horizontal line on your 30-minute chart, daily chart, whatever you like to look at. And there you go, measured moves. So you can use them in 2 different ways. These are, again, the 2 80-20 ways to use them. ABCD patterns, just add on the move from A to B, just add it on from C, so you know where the target is D. Or if you've got a range to work with, just do it just on the range. What's the distance in the range? Breaks out of the range. You just add it on and you know where the target is. Fortune telling, right? Telling you where the future is, what's going to happen. Fun stuff. Cool. Another thing on technical trading, trauma. Oh boy, I love this stuff. Trading trauma comes from human nature, right? One of those key things that we human beings experience. Most of us are adults here watching this video. So at some level, at some points in your life, you've experienced some kind of trauma, right? Now, let's just break it down, make it simple. 2 elements to trauma, recency and intensity. Recency is, well, it happened recently. So something that happened recently is more likely to affect you than something that happened a long time ago. It's more likely to affect your behavior today. Something that happened yesterday is more likely to affect your behavior today than something that happened a year ago, for example. Also, the intensity of the event matters. If it was a really intense event, it's more likely to have an impact on you than something that was irrelevant or not so intense, didn't really matter, right? So you put those 2 elements together, recency and intensity, you get trauma. It absolutely impacts your behavior today, here and now, in the present. So translating that to stock charts and price action and price structure, we have previous days levels. What are previous days levels? Well, you have levels on yesterday and 2 days before. Look at the highs and lows and the open and close prices of yesterday. Those levels, they just happened yesterday. So they have that recency element to them. And they're intense because let's say the high and the low, that was the absolute high and the absolute low of the previous day. It didn't go 1 penny lower or 1 penny above the high and low. So you can actually lean on that. That's a traumatic level, the highs and lows of yesterday. Also, the previous day's open and close. At what price did the auction open? And then at what price did the auction close? These are important levels. Trauma, they're intense. They're recent and they're intense. So I call them traumatic levels, previous days. Let's get into some of this. All right, oh, we'll go back to it. We'll get into fractal patterns here in a moment. But anyways, before we get into fractal patterns, trading trauma is really leaning in on these very recent levels and intense levels. And the way I like to define them is you just got to look at the previous 2 days. So the previous day, high, low, open, and close. And the day prior, just the open and close. Just the high and low, just the high and low. So you have those very intense levels, basically 6 lines automatically drawn on your chart that are what I like to call traumatic levels. And you can use them. You know that they are in play because they were just in play recently, just like human nature. They're traumatic. It just happened recently. It's impacting your behavior today. Same thing on a stock chart. It just happened recently. It's going to be in play today. Traumatic levels. So you can lean on that stuff and really take trades off of them. And we're going to get into some examples now. Okay, but before we do, a little bit of fractal patterns, and I'm going to bring this together. Traumatic levels, fractal patterns, put it together. Now you're getting something that you can really use. So real quick, I'm going to watch this video. It's about an hour, about a minute and a half long. And I'm just going to let you observe this, and then we'll get into what it really is. Here we go. All right. Pretty cool, huh? What did you notice? So the whole point here is the further you zoom in, you don't really change perspective. It looks the same. There's patterns within patterns and within patterns and within patterns. So those are called fractal patterns. They occur in nature all the time. It's a part of our universe, and we'll be using that for trading. So let's get into some of these fractal patterns. Here's one. Try and describe these patterns for you. There we go. So, like I said, patterns within patterns. Okay. Really fun and interesting stuff. And we'll layer this on top of those traumatic levels. So you can really get something you can lean on and put money at risk on. So the thing about fractal patterns is they look the same no matter what level of zoom you are at. You're zoomed out or zoomed in, right? So let's talk about zoom as far as stock charts are concerned. Here we have a 30-minute chart. Here we have a 1-minute chart. Take a look. It came down, found a bottom here, the low of the day on this day, traumatic level, right? The red line. And then in the pre-market of the next day, it broke down from that level, but then it very quickly came back in. Check it out. What do you have here? False breakout, right? And then sure enough, a retest right there, just like we said previously, false breakout, retest. Anyways, a double bottom is the bigger picture. A bottom here and a bottom here. That's a 30-minute picture. Okay, we're trying to focus in on fractal patterns here. Now take a look at the 1-minute chart. What do you see? A bottom here, and then after the open, it tested that bottom. Another double bottom, a pattern within a pattern. That stuff gets powerful. You trade fractal patterns. Oh man, you're gonna get some powerful trades. I mean, you can capture this move. Seriously, this is great stuff. So fractal patterns, basically a pattern within a pattern. So what you can do here is identify a bigger picture pattern on a bigger time frame. I just like the 30-minute. Use whatever you like. So you identify a pattern, and then you're waiting to see if the same pattern occurs on the smaller time frame. In this case, it does. Bottom here right before the open. As soon as it opens, in the 1 minute, in the first minute, drops down, bounces right off. You can take a trade off of that. And guess what? Let's layer something else on top of this. This is the previous day's low. Traumatic level, right? Look at this day. That was the high. That was the low. That was the closing price. And right there, that was the opening price. In this case, the low is in play. The low is a traumatic level because, well, it happened recently and it was intense. I mean, look how intense this one was. It dropped and didn't go 1 penny lower. It just pushed right up from there. Not a penny lower. That was it. That's the low of the day. So that's an intense level. Sure enough, it respects that right here as we get into this day. A bottom, second bottom, fractal pattern. So you see now we're layering these two things onto it. All human nature, really. And actually, fractal patterns are things that occur in nature. But using a traumatic level, well, using fractal patterns off of traumatic levels. And then you do this with asymmetric risk to reward. Now you're going to go print money. I'm serious. This is how you print money in the market. Massive asymmetry on your trades. But then you've got these two very powerful patterns you can just layer on top of each other, and they actually sync up very nicely. Fractal patterns off of traumatic levels. Nice and smooth, right? Let's get into a few more examples. Here's another one. Microsoft. Okay, it happened to reject right here and right here. So when it comes back to this area, was about 406, 406.50. What do you expect can happen here on the 1 minute chart? Well, it rejects. It actually happened to open right at that area. It pushed up a little and boom, it rejects. Right here, you can plan this trade before the open. You know that this is resistance. It's resistance, 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 resistance. I mean, it's just resistance. Straight up and simple. So you can plan that trade. If it's resistance again on the 1 minute chart, you can take that short. Your risk management is right here. You can enter right below it, stop loss right above it, right above the level you identify as resistance. Nice and simple, right? Fractal patterns, nice and smooth. And here's another level on traumatic levels that I want to talk about. This dark line right here. This is the opening price. Now you don't know what this is, what the opening price is until they open, right? The first transaction of the day, and it draws a line right there. Now that is significant. Again, that's the most recent traumatic level. It is because it just happened today as the price opened. So it's the most recent one. It is traumatic because a lot of times what you'll find is that the price respects the opening price. The stock respects the opening price. It might quickly run away from it and come back and reject again, or it might give you a breakout trade, whatever. The point is that you got to observe the opening price. It's one of those traumatic levels, just like the previous day's close, the previous day's low, the previous day's high, the previous day's opening price. And then 2 days ago, you got the low and the high. These levels are really all those significant traumatic levels I recommend you use. And then look for fractal patterns on these traumatic levels. And then execute with massive asymmetry. So if you identify this as a target down here, this is the opening price of the previous day. Well, you have this wick, it opens, it goes up, it starts to push down. You can take an entry based on your fractal pattern setup off of the traumatic level, the opening price. Short there, stop loss right above. Off you go, it hits your target. You start taking it off at your target. You're seeing a piercing pattern. Remember, we talked about candle patterns. Piercing patterns, increased volume, increased more than the previous ones. You can already tell that's it. That's the end of the move. And check this out. This volume is about the same. It's pretty weak. But look at this candle. This is a big candle. The volume wasn't proportionally bigger. That's already telling you that's a problem. That move is over. Before this candle even forms, before it even hits your target, you already know that this move is pretty much over with the volume and candle profile. And then it gives you a piercing pattern. And all this happens at a traumatic level. I mean, how much more confirmation do you want to take profits, huh? Really? It's amazing how many things just come together. And when they do, that's powerful stuff. And if you're watching the level 2, you may well have seen that there's big orders sitting at 403. If there was, I don't know. And then you have the tape. If you're able to read the tape, good stuff. I recommend you learn to read the tape. It's really powerful stuff. That takes a lot more time, but definitely a skill you want to build on top of this. So let's see another example. This one's a little more complex, but that's the fun about it. Check it out. Let's zoom out and look at this thing. 30-minute picture, downtrend. 1 minute picture. What do you see? Downtrend, a pattern within a pattern. This whole downtrend on the 1 minute is happening inside of these two candles right here. Right there. But look at it. It's the same thing over here. If you layer these charts on top of each other, they look the same. Like we saw previously, what was it? A double bottom and then a double bottom. Same thing here. You're seeing a trend within a trend. Right? You can trade this stuff and then trade this fractal pattern right off of traumatic levels. So let's look at traumatic levels. So you know it's a downtrend. So you're waiting to see a downtrend. But from where? Well, use the traumatic level. We have this dark line here. This is the previous day's close, right? And what you have at the previous day's close, you can see in the post-market, it was support. And then pre-market, it popped up and it resisted right at that previous day's opening price right there. right? It resisted, and then it came back down to support, previous day's close, and it broke that line. Very interesting. It broke that previous day's close and went all the way down, found support at previous day's low. Look at that traumatic level, huh? Definitely in play, previous day's low. And so what you know is that it broke this one that was support. That was support. Now you can use it as resistance, previous day's close. So that's resistance, that's support. And you're looking for a downtrend because it's in a downtrend. Simple, right? There you go. Look at this. This thing opened up. Opening price happens to be right at 180. It resists from the previous day's close. It gives you about 3 minutes of resisting from there. If you are able to spot this, you can take an entry, a short right up here within these first 3 minutes, stop loss right above, and you go for your traumatic level target, which is previous day's low. You know that is support because it was a support on the previous day. And even in the pre-market, it confirmed to you that it's support. Take your profits there. And take a look at this one. This is what I call a traumatic level flip. And it fits in with the fractal pattern. So this one gets a little complex, but stick with me here. So it gets down to this previous day's low, which we identified as support. But then it breaks through. And look, the boxer with the strong punch, volume right there. Boom. And then what does it do? It retests. Retests it, confirming that what was support is now resistance. It's just retesting that previous day's low traumatic level and confirming to you that it's resistance. There you go. Now you know that's resistance. It's a traumatic level. You can lean on it, and it's giving you a fractal pattern. This is a pattern within the pattern. You have another opportunity to take a short here. You can even start a whole new trade. Short, enter somewhere in this area, close to your level, stop loss right above it, off you go. The obvious target is 175. How do you know that? Well, 175 is a big round number. Take a look at the level 2. Scroll down on the bids, and you'll find on this day, remember, on 175, there was a great big outstanding bid over there. That's a target. That's a buyer just waiting for the price to come to him, and he wants to buy at 175, not 1 penny more. So hold it down there and take a look. As it approaches 175, boom, there's that buyer. There's that all that liquidity coming into the market. It's likely to be a bottom, this whole 175 area. And there you go. Now you can see on this one how it all came together. You got fractal patterns, a downtrend, so you're looking for a downtrend, and you get these fractal patterns off of traumatic levels. In this case, it happens to be the previous day's close and the previous day's low that you can use. And then it does a breakout with volume, like we discussed, volume and candles, right? The strength behind the punch, the boxer really breaks it out. Retest, just like we saw with the Wyckoff theory, retest of the level. And then you have the level 2 to show you that 175 is a final target right there. All this stuff comes together, and you can take big trades like this and really have some good P&L out of it. So this is really it. Now you see how it all comes together, technical trading, and you don't need a lot of technical stuff. All of these indicators, by the way, remember I was talking about past, present, and future? Well, the key ones, the bigger one, the biggest ones are the present and the future. Do you notice there are no moving averages here? There's just a VWAP, really, but no moving averages. And that too, VWAP only on the 1 minute. Because the moving averages are a representation of what has happened. It's the past. Therefore, I don't find it all that useful. What's most important is what is happening in the present and where it can possibly go. How far can this thing go? So that's the stuff you want to really check out. So how far can it go? Well, the future, you have this stuff here, the level 2. You can also look at measured moves if you're interested in that. You have, let's say, 181 here, and you have, let's say, 178 here. What is that? $3. Okay, so $3. Then from 178, you go down $3. Oh, look at that, 175. There you go, measured move. That's one range. That's one range. Even without using level 2, you can find your targets, right? So you get that as well. These are future tense, fortune telling. Looking at measured moves and level 2, the 80-20 of fortune telling in the stock market, really. And then you have the present tense, which is fractal patterns, patterns within a pattern. That's it. This is a pattern that's inside of this big pattern, right? Fractal patterns happening off of human nature stuff, traumatic levels, previous day's close, lows and highs, open and close. In this case, the close of the previous day and the low of the previous day are very much in play. You have all this stuff coming together, and then you're looking at the candles and volume as well. You see the boxer punching, real strong punch, knocking out that level right there, with that volume, that's the strength behind the punch. Get Wyckoff with the whole retest. You can see the wicks up there. It doesn't even close a candle above that level. It's firmly resistance. It gives you like 10 minutes of opportunities to enter this trade. Really, truly amazing. It did the same thing. It gave you about 3 minutes of opportunities to enter this trade going short. Fantastic, right? All this stuff, put it together, and it's not too complicated. Truly, it isn't. It really does sync up nicely. And there you go. There you have the majority of technical trading, leaning on the present and the future far more than the past. And remember, we're talking about horizontal lines. You might say, okay, that's the past. Well, it's trauma. It's the recent past, and it was really intense. So it has an impact today, here and now, in the present. And that's called trauma. Something that happened in the past that impacts you today, we call that trauma. That's human nature. Leverage human nature. You're a human being, right? Last I checked. Check yourself. Are you a human being? You should be. If you're a robot, this presentation really isn't for you. Okay. So use that. I'm just leaning on the present indicators and some fortune telling, the future indicators, nothing more than measured moves in level 2. And you can get some pretty cool results. So one thing on fractal patterns here, the research tells us that we human beings experience less stress and better well-being when we look at nature, and that is driven by fractal patterns. So, I don't know about you, but I find day trading to be a tremendously stressful endeavor. Truly, it's a tough one. Okay, it's a tough job. There's no doubting that. So why not introduce some elements that help alleviate the stress? So fractal patterns. That's it. That's where I got it from. So I started exploring it and came up with this idea where there's patterns inside a pattern, 30-minute chart, 1-minute chart. There you go, straight up and simple. So really, it actually speaks to us, fractal patterns, speaks to our nature and kind of calms us down a bit. Whether you know it or not, that's the research says that's what you're all about. If you're a human being, that's what you're all about. You like nature, and that's driven by fractals. So, hey, try it out, use it. Well, I've experienced it and it works. I think it's great. Now, getting into trading, we talked about indicators, various categories of indicators, how to use them, all this stuff. So here you go. For you to have a sustainable style of trading, your style of trading has to be a reflection of your personality. Now, this is very, very, very powerful, very important. Because if the trading style you're using is not a reflection of your personality, you will just be battling yourself. You'll be sweating. You'll be anxious before the market even opens. That's the real problem. You don't want to be fighting it and you're unsure of it, but you have to risk money on it. That's going to hurt. You're going to hurt yourself doing that and probably blow up an account or two. Think of a wood carver. You give a wood carver a great big log and you ask him to carve out a wood carving. First thing he'll tell you is the carving is already in the log. It just has to be revealed. It's not something outside that has to be created now. It's already in there. It's this art form. Like this guy just closes his eyes and just starts carving away and the carving is revealed. So it's a little, it can bend your mind a little, but the truth is the carving is already inside that log. Just has to be revealed. And this is the same as your trading style, the style that is going to be sustainable for you. It has to be a reflection of your personality. It's already in you. You just got to reveal it. It is not something out there, a strategy that you're going to learn from somebody or on YouTube or in a book. You can start there, learning different strategies from different people and different courses and things. That's very, very good. But that's a starting point. What you got to do is then adjust it, evolve it based on your personality, based on the way you perceive things. If you're able to able to grasp traumatic levels and you try it out and it's working for you, okay, you start using that. But if you find that it's confusing you, drop it. Just drop it. Use other stuff. Use moving averages if that works for you better. Now, it's a past indicator. I just don't think they're as powerful as present indicators. But hey, you've got to go and reveal your own trading style. That's the important part. That's where mentorship comes in, mentorship with people more experienced and being in a community, being in a group, all that stuff. That's where it really comes in because you need to keep evolving as a trader and you have to evolve your style again, which is going to have to come from inside of you, not something outside of you that you adopt. You make $1 million tomorrow. It's not like that. The fact is, it really is not like that. All right. So one of the things also that you got to identify when you're trying to figure out your trading style is the pace at which you like to function. Some people are adrenaline junkies. They like the action. They want to be in it right at the open, all that volatility, momentum. They need that. Otherwise, they're a fish out of water. They're struggling. They're not sure what's going on. They can't handle the slow pace. They just function at a faster pace. There's others who are very analytical, let's say, and like to function at a very slow pace and like to take their time to accumulate information and then evaluate that information and then make a decision whether to go long or short or even to take a trade or not. So even that is something that is in you, and you've got to identify your personality traits like that. Identify where you sit on that spectrum, and you could be anywhere in between. And then your trading style should be a reflection of that personality trait of what pace do you like to function. You go with the fast momentum stuff, or you take, you wait for a week for it to set up and then you take a massive trade. None of them are wrong. Both of them are right. But what's right for you is what's going to be based on your personality and what pace you like to function. And you also have triggers, and triggers are very, very important. Triggers, what I'm talking about are things, here we're talking about day trading. So let's talk about indicators, right? We talk about indicators plenty. Indicators are triggers. Triggers that trigger you to take action. Those indicators are telling you something. Okay, it's bullish. Oh, it's bearish. It's support. It's resistance. Those are all triggering you to take actions. Now, everyone's a little different. Everyone has their own tendencies. Now, when you get triggered into some behavior, you've got to identify whether that behavior is productive to your trading or destructive to your trading. And the ones that are productive for your trading, you got to adopt those, make them a part of your trade book. The ones that are destructive for your trading, you got to put rules in place. You don't fall into those traps. Typically, these come from triggers that are right on your screen. So, for example, if you get triggered by moving averages to that, every time it bounces off a moving average, you take a trade, but then you find that you stop out quite a lot and you're having a lot of failed trades off of these moving averages. Well, you know what just happened? You are getting triggered by these moving averages to take trades. And the truth is that's a destructive tendency you've got. And you get triggered into it by moving averages. It's destructive because look at the results. You're getting stopped out all the time. Okay. So remove the trigger. Remove the moving average. Right? Let's use it another way. Let's say same thing on the moving average. Let's say you get triggered to take a trade every time it bounces off a moving average, and the way you interact, the way you tend to behave with that trigger is that you take a position and it turns out most of the time you're making money out of it. The P&L at the end of the quarter, it's all positive. Every time you took that trade, most of the time it worked out and you got big winners. Okay, so now you have a trigger that's triggering you into a behavior that's productive for your trading. Keep that trigger on your screen and make that a centerpiece of your trade book. That's it. You're a moving average trader. For example, that's just one example. I showed you some of my triggers there. Fractal patterns, traumatic levels, level 2, measured moves. Those are my triggers, my positive triggers. My negative triggers, you didn't see them because, well, they're not even on my charts. They're gone. They're long gone. And if I find any more, they're going to be gone too. Right? So you got to really develop your trading style. And the style that is sustainable for you will be a style that is a reflection of your personality. It's got to come from within you. And the way to do that is to identify your triggers, identify your behaviors based on those triggers, eliminate the triggers that are destructive, maintain the triggers that are productive, that inspire you into productive behavior, and trade off of those. Again, remember the wood carver. The carving is in the wood. It's an art form. It's already in there. It just has to be revealed. Your trading style is in you. It's within your personality traits. You just got to reveal it. And also don't forget that can change over time. We all evolve, right, as human beings. And that will also change over time. So be aware of that. So yeah, here we go. Which indicators should you use? Well, the ones that are easy on your eyes, the ones that are easy for you to interact with, and they don't drain you and you don't stress out about figuring out what that indicator means. If you're doing that, then remove it. It's draining your energy. You really don't want to do that. Okay. You should use a trading style that is simple at the technical level so that it only occupies or only takes about 10% of your energy, the technical stuff, so that you have 90% of your energy in reserve to manage the risk versus reward and to manage your emotions. Don't forget, you got money on the line here. You're gonna get emotional. You know why? Because you're a human being. That's why. Simple enough, right? So you really gotta make sure that the technical side of trading is as simple as possible. The bare necessities. This is from Disney. Remember the Jungle Book and the bear and the kid was growing up in the jungle with the wolves, all that fun stuff. So the song in that movie is great. The bare necessities. Look for the bare necessities in life. I love that song. Great song. So check it out in day trading. The bare necessities at the technical level. Because the truth is, you need the majority of your energy to manage risk versus reward and your emotions. Absolutely critical stuff. Otherwise, well, put on a bunch of triggers on your charts, a bunch of indicators, and you're in a mosh pit. Really, all these things are going to conflict each other. Some of them are going to confuse you. Maybe they all line up together, but still you don't know what they mean. And it's a mosh pit. You like mosh pits, go to a heavy metal concert, or put a bunch of indicators on your chart. Same thing, really the same thing. If you've been to a metal show, you probably know. Most of you have, I'm sure. So either keep it simple with the bare necessities, or go to a mosh pit. And I don't recommend moshing when you're trading. It doesn't work, okay? That's disruptive. And one last bit here on evolution, human beings. After you do this stuff for a long time, as in trading, and you're trading off of indicators and patterns and candles and volume, all this stuff, what you'll end up doing and the evolution of it is you'll actually evolve very naturally. It happens to almost every trader I know. You'll evolve to a point where you don't really look at the candles anymore, or not even the indicators that much. You're just able to instinctively identify where the buyers and sellers are. As in, it becomes a subconscious activity. You're not consciously aware anymore that you're watching the level 2, you're watching the wicks for the tweezer tops and bottoms, you're watching fractal patterns and chromatic levels. After you do it long enough, you just don't notice it anymore. You just end up saying, oh, I see buyers there, I see sellers there, and off you go. That's when it gets fun. Really, that's when it gets fun. So once you identify your trading style that is workable for you, sustainable for you, then, well, you sustain it, right? You sustain it, you do it for a long time. After you do it for a long time, it becomes second nature. Again, evolution, right? Human beings. It becomes second nature. And when it's second nature, what that means is you do it without thinking. And you don't even know what you're doing. You really don't. You just see buyers and say, oh, I see buyers, I see sellers way above the price right now. Okay, here we go, long. Off you go, you got to trade. That's it. Really, that's where you want to get to. But you can't get there. Not unless you first find a style that is sustainable for you, keeping it minimalistic, bare necessities, and then stay with it. Stay sustainable. Sustain it. Keeping it simple, managing your emotions as you go in and out of the market every day, making money, losing money, doing it all. Eventually, you'll get to the point. As long as you survive the learning curve, you get to the point where you're doing it instinctively, and it's kind of hard for you to even describe it if somebody asks you, tell me your trading style. It gets hard to describe it. It took me a long time to put this presentation together just to break down how I trade. And I realized, oh crap, it's fractal patterns. It's chromatic levels. Okay, here we go. But the truth is, a lot of times nowadays, I just see buyers and sellers, and I just trade on that. At the conscious level, that's all I'm doing. And that's where you want to go. When you start doing it that way, trading becomes stress-free. It's never completely stress-free, but it's a lot of it is eliminated. And you have confidence in what you're doing. You know that stop outs are a perfect normal piece of the game, and that winners are always bigger than the losers. And that's it. So that's what you can look forward to. You can look forward to evolving into a really good proficient trader. When you keep it simple with the technical stuff, focus on risk to reward, and you're sustainable. So that's all I have for you in this video. I hope it was good for you. Hope you got something out of it. And I will see you in the next one very soon. Take care.